name is Chung, and my three topics are acquisition control, amalgamations, and voluntary disclosure programs. Oops. There we go. The first topic, acquisition of control. A quick outline of what I'll be talking about. What is acquisition of control? What is tax impact of acquisition of control? What is the impact of deemed year-end upon acquisition of control? What happens during an acquisition of control for tax purposes? And what are some tax planning points? An acquisition of control occurs when there's an individual or a group that acquired control and it's different from the individual or group that controlled the corporation previously. Acquisition of control doesn't apply to acquisition of shares from related parties. So after the sale of shares, one person must control the corporation. If no one controls the corporation, then the acquisition of control does not apply. A loss of control is a change of control, which doesn't necessarily mean that it is an acquisition of control. So please bear in mind that quote unquote change in control and quote unquote acquisition of control are not the same for tax purposes. So for example, if Bradco owns 100% of ACO before, and then after, Bradco owns 45%, and Jamie co-owns 45%, and Aaron co-owns 10%, there's no clear acquirer of control. So therefore, there's no acquisition of control. But if Bradco owns 45% and Jamie co-owns 55%, there is an acquisition of control, assuming that Bradco and Jamie co are arm's length. So what is the tax impact of acquisition of control? There's a deemed year-end on day before the acquisition of control. An example is Mr. X acquired shares from Mr. Y on July 1st that resulted in an acquisition of control for XYZ Corp. And XYZ has a December year-end. As a result of acquisition of control, there's a deemed year-end as of June 30th. The short taxation period is from January 1st to June 30th, and the next taxation period starts on July 1st. The impact of deemed year-end is that the non-capital losses and shareholder loan payments are aged by another year. Small business deduction and CCA are prorated by a number of days in the short taxation period. You can choose a new year-end on the following taxation period. Usually it makes sense to choose the same year-end as the acquirer. For example, if the acquiree has a December year-end and the acquirer has a June year-end, and acquisition of control took place on April 1st, the acquiree would likely pick a June year-end to match the acquirers. So their short taxation period is from January 1st to March 31st. Don't forget there's an acquisition of control on April 1st. And the next taxation period is from April 1st to June 30th, which is also the acquirer's year-end. So after acquisition of control, the net capital losses, allowable business investment losses, property losses, and unused charitable donations all expire and cannot be carried forward after the deemed year-end. All assets are required to be tax deducted down to this fair market value. For example, if you have capital asset pool and they're worth nothing now, you can take a terminal loss and create additional non-capital losses. Capital gains incurred during the short taxation year will use up the expiring capital losses. For non-capital losses, they're subject to streaming rules that have certain conditions. For one, they must be applied against the same or similar business. Two, there must also be reasonable expectation of profit. And three, non-capital losses will age by 1 year due to the short taxation period that I mentioned earlier. So for those of you in the resource sector, successor rules apply at the acquisition of control. Successor rules basically means that the successor, quote unquote, the acquirer, may only apply successor expenses against income from production from and proceeds of disposition of the properties acquired from the original owner. There are some tax plan opportunities during acquisition of control. To structure around the expiry of capital losses, the corporation can elect to trigger accrued capital gains to use against its capital losses that would otherwise expire. Please keep in mind that there may be CCA recapture that may offset the non-capital losses when you're determining the asset bump up. You also have the option to change the acquisition of control date to avoid multiple short taxation periods, if possible. For example, if a transaction also involves an amalgamation, you may want to time the amalgamation with the acquisition of control to be used at the same time, so only one deemed year end is necessary. The next topic is amalgamation. A quick outline I'll cover for amalgamation is what is Section 87, what are some of the criteria for Section 87, what are the effects of rollover, and due to time constraint, I'll only be speaking in the context of a vertical amalgamation, which is also referred as a simplified amalgamation. I'll also be talking about the deemed year end due to amalgamation and the effects of loss utilization. So Section 87 of the Income Tax Act deals with amalgamation. Amalgamation happens when two or more corporations merge and form a new corporation. Under Section 87, two corporations can transfer their assets to the new corporation tax-free. The criteria for Section 87 are: 1, the predecessor corporations must be taxable Canadian corporations. All the shareholders of the predecessor corporations must receive shares of the new amalgamated corporation, which I will call Amalco. The shareholders must also receive shares in Amalco, and no other considerations are allowed. And 4th, the original shares held by the shareholders of the predecessor corporations must be held to earn capital income rather than business income. And lastly, the last criteria for Section 87 is that all assets and liabilities of the predecessor corporations, other than intercompany balances, must be transferred to the Amalco. So what are main effects of the rollover? All assets of the predecessor corporations must be transferred at tax value. No income, capital gains, or recaptures are triggered. And all tax balances such as non-capital losses, net capital losses, resource pools, ITCs, all flow through to Amalco. Here's an illustration of a vertical amalgamation. A typical setup is the parent and the sub merge to form Amalco. Another common transaction we often see is when a foreign co wants to acquire a Canadian company. So what typically happens is the foreign co would set up a new Canadian corp called Acquire Co. The foreign co would put the same dollars as equity into Acquire Co to purchase the target co. The Acquire Co would then amalgamate with Target Co. The advantage of this is that the deferral of Canadian withholding taxes on the distribution in the form of return of paid up capital. If a foreign co acquires a Canadian co directly, the amount paid to acquire the shares of the target co can only be returned to the amount paid to acquire the shares, the foreign co up to the extent of the existing paid up capital free of withholding taxes. However, if the foreign co incorporates a Canadian acquire co, the tax basis and the paid up capital of the acquire co would both be equal to the purchase price, assuming there is no debt financing. So of course, paid up capital is good because it can be repatriated to the foreign co free of Canadian withholding tax. There's a couple of ways to structure a vertical amalgamation tax-free. One is using Section 87 of the Act. It can be used at any time a parent and a sub merge. Parent does not need to own 90% or more shares of the sub. You can also do a Section 88, which is the wind-up section in the Act. You can also do a wind-up when the parent owns 90% or more of shares of the sub. In the end, you basically obtain a similar result as Section 87. With Section 87, you're allowed a bump up. So a parent must own 100% shares of the sub. When a parent and a sub merges, the net assets are transferred at tax value. This doesn't seem quite fair because the parent likely paid a higher price when they purchased the sub, So therefore, the CRA allows a bump up to ACB of non-depreciable capital properties that the sub must continuously have owned after a parent acquired the sub. So I'll go through a quick example. Parent purchased 100% shares of sub for $500 on July 1st. The sub only owns land and has no liabilities. At time of acquisition, the ACB of land is $100 and the fair market value is $200. On December 1st, the parent and the sub amalgamate. Tax value of the net asset of the sub is $200, and the sub still owns the land. So using the bump up formula in section 87, the bump up of the land is lesser of A, $500, which is the purchase price, minus $200, which is the net tax value, for a difference of $300. And B, $200, which is the fair market value, minus the $100, which is the ACB, for a difference of $100. So in the end, the lesser of A and B is $100. So that's the amount that you can bump up. So the new ACB of the land is $200 instead of the original $100. So it's a bit more fair in situations where the parent paid a higher price for the sub, like I said earlier, than the tax value the sub owned in the asset. On amalgamations, there's a deemed year end 1 day before the amalgamation day, just like an acquisition from control. The new Amalco begins its taxation year on the day of the amalgamation. So if the amalgamation happened on July 1st, there's a deemed year end on June 30th. And then the new Amalco starts their taxation period on July 1st. The small business deduction of $500,000 needs to be prorated. The CCA also needs to be prorated. And at the same as acquisition control, the non-capital losses are aged by 1 tax year. In a vertical amalgamation between the parent and 100% owned sub, losses realized after an amalgamation can be carried back against income of the former parent. For other situations, the non-capital losses and net capital losses flow through to Amalco. This means that it can be carried forward against the income of Amalco. Again, for those of you in the resource sector, successor rules does not apply to Amalco post-amalgamation. So as I mentioned earlier, successor rules means the successor may only apply successor expenses against income from production and proceeds of disposition of properties acquired from the original owner. Again, this doesn't apply to Amalco post-amalgamation. The Amalco can also claim resource deductions that was carried forward by the parent and the sub in its first taxation year. The amalgamation really has no effect on shareholders, provided that all the criteria as previously mentioned are met. The shareholder is deemed to dispose his shares in the predecessor corporation at ACB and then acquired a new Amalco at the same ACB. So essentially there's no tax effect. My last topic is voluntary disclosure program. It's a broad-based program administered by the CRA. It's created by the CRA to allow taxpayer to disclose inaccurate or incomplete tax reporting in exchange for potential penalty relief. The VDP program can be used by individuals, trusts, or corporations. So in order to qualify under the voluntary disclosure program, it must satisfy 4 conditions. 1, the taxpayer's disclosure is on a voluntary basis. So this means that there can't be any request to file from the CRA. Number 2, the taxpayer must provide a full and accurate reporting, and disclosure must be complete. Third condition, the disclosure may involve penalties. And last, the disclosure involves information that is at least 1 year past due. A few things to keep in mind about the voluntary disclosure program. It is ultimately granted at the discretion of the CRA. There's no guarantee that the penalties will be waived. However, from our experience, it generally works, but you must make sure that all 4 conditions I previously mentioned are met. So oftentimes when we see a CRA, when they reject a VDP, it's because it wasn't on a voluntary basis. So the CRA had made a request to file, but this taxpayer just didn't know about it, whether it was got lost in the mail or they made a phone call and nobody answered. So just, be sure, just be aware of that. Also from our experience, it's commonly used for T1135, T1134, and T106 foreign reporting. Just a quick recap, 1135 is the foreign income verification statement. The T1134 is the information return relating to controlled and non-controlled foreign affiliates, and the T106 is the information return of non-arm's length transactions with non-residents. The last comment I want to make about the voluntary disclosure program is that the CRA is not trying to catch anybody or make people fess up. It is a useful program to come clean and potentially avoid the late filing penalties. Like I said earlier, we have had pretty good success with it, but if only if all four conditions that I previously mentioned are met. And that's it. Thank you for listening.